Welcome. Today, we are cracking the code of market structure. You know, that hidden language that's playing out on every single financial chart? We're going to show you the exact framework that professionals use to read the story that price is telling us moment by moment.
You know, when most people look at a price chart, all they see is chaos, right? Just a totally random jumble of lines going up and down. But what if it's not random at all? What if it's actually a story with its own grammar, its own rules, and its own rhythm, just sitting there waiting for you to read it?
And this quote right here, it just nails it. It gets to the absolute heart of the matter. See, most retail traders, they're always looking in the rearview mirror. They're reacting to where the price has already been. But the pros, they're looking ahead. They're focused on where the price needs to go next because they actually understand the forces that are about to drive it.
So our goal here is pretty simple, really. We're going to shift your entire perspective. By the end of this, you're not going to see noise anymore. You're going to see the narrative. We're going to give you the framework to start thinking like a professional.
Okay, let's start with the absolute basics, the foundational grammar of the market. I don't care what time frame you're looking at. Every single market exists in one of three simple phases. And understanding these, it's completely non-negotiable.
So first up, we've got the uptrend. And the rule here is incredibly simple. Price is just making a series of higher peaks, which we call higher highs, and higher valleys, which we call higher lows. As long as that pattern continues, the story is bullish. It's optimistic, and your bias should be to buy.
And no surprise here, the downtrend is the exact opposite. In this case, the market is printing lower lows and lower highs. So each peak is lower than the one before it, and each valley is deeper. The narrative here is bearish or pessimistic, and the bias should be to sell.
And finally, there's consolidation. This is when the market just gets stuck in a range, moving sideways. It can't seem to make up its mind. It's basically a story of pure indecision, a tug of war between the buyers and the sellers. And honestly, during these phases, the smartest move is often to just do nothing at all.
So this, right here, this boils everything down. Forget all the complex indicators and squiggly lines for just a minute. These two simple patterns, higher highs and higher lows for an uptrend, lower highs and lower lows for a downtrend, that's really all the grammar you need to figure out the market's main direction.
Okay, so now let's look at how these trends actually build themselves. See, markets never travel in a perfectly straight line. They breathe. They have this distinct rhythm to them, kind of like a two-step dance of expansion and then contraction.
And that dance has three key steps. First, you get the impulse, which is a really strong, powerful move in the direction of the trend. Then you get a correction, which is a weaker, temporary pullback. And finally, you get a new impulse wave that actually breaks past the previous peak, confirming that the trend is, yes, still very much alive.
And that key moment of confirmation? It's called a break of structure, or BOS for short. It's that instant when the new impulse move shoves the price right past the old high or low. You can almost think of it as the market shouting, "Yes, this trend is continuing." It is the signal that validates everything. So, now you know the grammar and you know the rhythm. But here's where it gets tricky, because we need to talk about where most people go wrong. Sometimes the signals you're seeing, they aren't real signals at all. They're actually very sophisticated traps. Okay, one of the biggest mistakes traders make is getting lost in what's called internal structure. These are all the little minor wiggles and jiggles that happen inside of a larger impulse move. They don't actually break the major swing points, so they don't change the bigger story. And treating them like they do, it's a recipe for disaster.
Now, let's talk about the most devious trap of all, the liquidity sweep. This is what happens when price briefly stabs past a really key level, but only with that thin little wick of a price candle before it violently reverses. It's designed to look exactly like a breakout, but it's the total opposite. It's not a breakout, it's a hunt.
So the huge difference between a trap and a true confirmation really comes down to this: wicks versus bodies. A wick that pokes through a level means rejection. It means price tried to go there, but it got shoved right back. But a full candle body that closes past the level, that means confirmation. It means the market has accepted that new price. Seriously, understanding this one distinction can change everything for you.
So, you might be wondering, why do these traps even exist? Are they just random? Oh, not at all. To really get it, we have to stop looking at the chart like a retail trader and start asking what the big institutions are up to. And the answer, in one word, is liquidity.
Now, liquidity sounds like some complicated fancy term, but it's really not. It's just where the orders are. See, huge clusters of buy and sell orders, especially people's stop-loss orders, they naturally build up just above recent highs and just below recent lows.
And this liquidity, it's like fuel for the market engine. The big institutions needed to fill their massive positions, so the market is drawn to it like a magnet. And this right here reveals the institutional playbook. It's often called the power of three. First, you have accumulation, where the price just chops sideways, building up all those orders. Then comes manipulation. That's the liquidity sweep we were just talking about, a total fake-out designed to grab all those orders. And finally, after absorbing all that fuel, the market launches its real distribution move, a powerful, explosive trend in the opposite direction.
So you see, that liquidity sweep, that trap, it isn't some random failure on the chart. It's the manipulation phase in action. It is an engineered event designed to trick retail traders into giving up their orders, which becomes the liquidity the smart money needs to get into the market. The trap is a feature, not a bug.
All right, let's pull all these threads together now. Learning market structure isn't really about memorizing a bunch of patterns. It's about completely rewiring your brain to see the market's true purpose.
This is the ultimate shift in perspective. You go from being a passive observer of shapes to an active interpreter of intent. You stop just seeing highs and lows, and you start reading the story, the buildup of liquidity, the hunt for that liquidity, and the powerful move that always follows. You're no longer just reacting to the past, you're starting to anticipate the plot.
And it all comes down to this one question. This changes everything. It shifts your focus from looking at the exhaust trail the market leaves behind to looking for the fuel it's constantly hunting for. Start looking for those pools of liquidity, and you'll start to see the story of the market unfold before it's even been written.